Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president and financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome to Something More with Chris Boyd. I'm Chris Boyd, and I'm here with Russ Ball. We are both of the AMR team at Wealth Enhancement, and glad to have you joining us. You know, the Fed has been in the news quite a bit these days, so I thought we would talk a little bit about what is going on with the Fed. Well, it seems like a lot of activity and a lot of speculation, and so let's get into it. Let's start off with Russ. It seems like the president has we know for the last several months, he's been really focused on the Fed chair and the desire for Fed Chair Powell to reduce interest rates, for the Fed Reserve Fed funds rate to go down as an effort to stimulate more economic growth. And the Fed has been somewhat hesitant to do that, paying attention to data and saying it's unclear. And lately, the president's what's he calling him? He's like too slow or something. I forget. He's
definitely hurling insults left and right.
So I forget. He's got some nickname for him. I forget what it is now, but the idea that he's too late, maybe it was something like that.
Oh yeah.
But anyway, after the whole, when inflation kicked in 2022 or 21, and the Fed was somewhat late to jump on that. Now, the Fed is concerned because on the one hand, there is signs of inflation, while at the same time, there are signs of weakening in the economy, whether it's unemployment or wherever. So what will happen remains to be seen. I think this week the Fed has a meeting that'll be in the news quite a bit with their Jackson Hole summer meeting. And so that's one aspect of this. But it seems as though like we saw maybe a week or two ago, the president went out to the Federal Reserve where they have some big construction thing going on with renovations, and I think the president was trying to call attention to potential cost overruns in an effort to try to undermine Fed chair, because he has a term that doesn't end until sometime in 2026, and the president would like to replace him right away. But so one way he's trying to do that is to say, oh, malfeasance, he hasn't done a good job as Fed chair, and he hasn't been paying attention to some of these issues, and that may be the approach they get at trying in an effort to remove the Fed. Now, the Fed has historically been independent of political pressures by and large. Most administrations do not try to pressure the Federal Reserve in terms of monetary policy. The Federal Reserve, the central bank, is responsible for monetary policy, and monetary policy relates to this effort to try their dual mandate of trying to manage inflation on the one hand and employment on the other hand. Russ, I know you have some insights for the historical context of the Federal Reserve. Maybe we can take a minute to talk about that, and then we can come back to this issue of what the president's trying to do, and maybe a different tack he's been taking over the last week or so.
Yeah, definitely. I think because the Fed has been in the news so much recently, pretty consistently, but maybe more so recently with Trump putting the microscope on Powell and really trying to create a full court press against Powell himself.
Yeah.
So anyway, going back into the history of the Fed was kind of interesting. Basically, in the early 1900s, it was more enmeshed with the executive branch, and the Treasury Secretary was essentially the Fed chair initially. Then in World War I, the Fed was trying to basically help banks subsidize the cost of the World War One by lending money to banks for buying Liberty bonds. Anyway, fast forward to the 1950s. There's
when did the Fed get actually created as an independent? I think wasn't it in the aftermath of like the 1920s? You know, that with the crash was it part of that legislation that led to the FOMC and all of this?
So I don't know the exact details,
Okay.
but I think that there was a period after there was some more independence prior to the Great Depression, and then after the Great Depression, Roosevelt kind of stepped in and took more ownership of the Fed and monetary policy in order to help deal with the aftermath
with the Great Depression.
Of the Great Depression, exactly.
Yeah.
And then slowly started shifting a little bit into the 1950s, and it was not until the 1950s where the Federal Reserve really became its own
sort of independent
entity.
So in the case of the Fed right now, although where it falls in oversight and all of that, it's funded to some extent by the Congress. However, the Fed is run with a lot of autonomy, and this is sometimes a complaint that people have about, is it accountable?
Yeah.
So in any case, this is one of those challenges that I think often we've seen, whether it was Ron Paul or who's the Senator Paul now? Rand Paul.
Yeah.
So they both have had, Ron Paul's retired, but they both have had those critiques of the Federal Reserve over time, and the desire for audits and all this kind of stuff.
Yeah, there is this like historical push and pull between the independence of the Fed versus should it be something that is run by elected officials and
right.
Is more in line with the leading party, that kind of thing.
The merits of the argument of its independence, I think, is one that largely markets have appreciated, because it's not a political move. It's for the benefit of stability in the economy, and that is appealing to markets. So you don't super juice the economy and then have a overheated economy and then a crash of a recession of some kind. You tend to get this effort to create greater stabilization within the economy, so that if it's running too hot, they slow it down. If it's running too cool, they speed it up. So that kind of thing. And various tools. The largest, most commonly utilized today is the short-term interest rate that the Fed focuses on. During the Great Recession, we saw the Fed try to also move long-term interest rates through what became known as quantitative easing, and quantitative tightening later on. So there's the purchase of bonds on the far end, the more longer term bonds, has been a newer development as a consequence of the Great Recession, but it has not historically been an active part of what the Fed does. The Fed primarily focuses on money supply and the short term interest rates. Fair enough?
Yeah, exactly. And I think, going back to some of those periods in history where there was that dynamic of, is it going to become, more enmeshed with the executive branch, or is it going to remain independent? Those sort of battles have taken place throughout history. This is not the first time that this has happened. And the Fed really took a stance in the 1950s with Truman, who was looking to lower interest rates so he could pay less for the obligations from World War II. And
soon after, what was it, Eisenhower? You've got the infrastructure that came, a lot of highway system and all that kind of stuff that came out, a lot of expense. And
so there was a lot of borrowing for those, and if the interest rate is higher, that means that we're going to end up paying more for those debts.
Mm-hmm.
So Truman tried to basically talk to the Fed chair and try to talk him into lowering interest rates. The Fed took a stance and decided, no, we really need to maintain our independence here. If we don't, we're going to lose all credibility,
Mm-hmm.
and that's going to create another economic issue, down the road.
Interesting.
So Truman relented, and the Fed really became independent once more. That kind of consisted until Nixon came in, and then at a push for Nixon's reelection campaign, he wanted interest rates to come down again. And for the most part, presidents want interest rates to come down to improve
Stimulate
the economy
and
make
conditions.
Yeah. So that was the case with Nixon. And very interestingly, there was a similar sort of smear campaign against the Fed chair at the time. And in that case, Nixon sort of won over, and it created this whole stagflation issue in the 70s. So
interesting.
It wasn't, there are other factors as well, of course, but
Yes,
that was a big issue was, the decisions that Nixon made, the pressure he put on the Fed chair at the time really created issues down the road. It wasn't immediate, but it showed up down the road. So that brings us to the 70s and the stagflation that was seen there. That was hugely momentous for that time. And
in comes Paul Volcker.
In comes Paul Volcker. And interestingly, with Volcker, he was, when he was courted by Jimmy Carter to be the Fed chair, he was insistent on having that independence because he knew that it was going to take radical measures to be able to reduce inflation and bring the economy back into order. So basically his agreement with Jimmy Carter was, all right, let's get some independence, then I'll do it. Jimmy Carter said yes, and Volcker, as history knows, it really had
shocks the economy
impact,
by raising interest rates sharply to get inflation under control, and then of course simultaneously we had fiscal policy under the Reagan administration with a revised tax code, and we're off to the races for some a decade plus as the U.S. economy really seemed to heat up. Of course, we had other factors in that the emergence of technology in that era. So in any case, so all these kind of contributing factors to have greater stimulus in the U.S. economy. You have more on that? I wanted one other thing.
One more piece. So with Volcker, he knew that what his raising the interest rates and restricting the monetary supply was going to have dramatic effects on the economy, that it was going to cause a recession. He basically forecasted that. It did happen, multiple recessions during that time frame, but he stuck to the game plan. And as painful as it was, the economy did recover and started on this new phase of prosperity.
And this huge period of time under Greenspan, who was maybe in some arguments more friendly to business in the process. One of the things that I was thinking about when we talk about the history of the Fed, and I want to get into the current politics of it a little bit too, but we've talked about cryptocurrency a bit on the show from time to time, and the idea that people are attracted to it because of decentralized finance, as the DeFi as they refer to it, and this notion that we don't want government involved. And I often make the comment that there's a real virtue to what the Fed has done when we look at, for example, most not long ago in recent memory with the financial crisis and the Fed's active, maybe beyond their powers in some arguments, the things they did to stabilize the financial system and the banking system. But more recently, we saw it under Powell with a couple of years back when there were some problems with Silicon Valley Bank and First Republic and a few of these banks that had some problems. It gave a real clear visual of, what is it that the Fed has done at times is be able to step in, stabilize the banking system to a point where the public doesn't, we don't see these panics. They used to call them panics, but these panics where people would want to have the run on the bank and pull their money because they have this backing from the Federal Reserve structure. And I pointed out from time to time, because when people think about, there's been a lot of focus on stable coin and some recent regulatory developments. There's still a difference in the banking structure, with the Federal Reserve having the ability to offer backstop and various resources when there are times of stress on the system. And that's why we have a Federal Reserve in many respects, right? It's a combination of these dual mandate, try to help with and mitigate inflation, keep inflation in check, and have a more full employment. If the economy is so disrupted, or the banking system is so disrupted, that will create a lot of unemployment and a lot of problems. So the banking system is part of what the Federal Reserve has a hand in monitoring and governing in many respects, with the requirements that are placed upon the banks. So with all that said, little bit of the history. Thank you. But there's also what's going on now. So we were talking about the president pressuring Chairman Powell and trying to move interest rates with the intention of maybe replacing the Fed chair. The president seems to have, or his administration seems to have maybe moved on a different tack slightly, where they had a recent resignation from a Fed governor who was replaced with someone who's more friendly to the president's agenda of lower interest rates. And then this week we saw the president going after another Fed governor with Cook, was it, with this interest in saying there was some perceived controversy and saying you should resign. So he's looking to start packing the Fed with people who are more sympathetic, maybe a more MAGA agenda with lower interest rates. So that now this just as an aside, this question, I don't know if you saw this article about Lisa Cook, the Fed governor, who was accused of mortgage fraud. And essentially what happened is she has two mortgage loans. She has a home in Michigan and a condo in Georgia. And they're both on the mortgage application apparently as primary residences. And you get a better mortgage terms when it's a primary residence than a secondary residence. And so the president put out a Trump social tweet, or whatever you call those. Cook must resign now. So it's a little bit of pressure trying to remove now whether or not this is actually people are saying, well, there's one question of like, how it's raised on the application could be relevant. Was it that she lied on the application? That could be a problem. Was it that there was a question, do you plan to make this your primary residence? And maybe she did.
Yeah.
Right. Yeah. So I don't know the answer to those things, but in any case, she's one of the members of the Fed who is saying it has been thus far keeping interest rates steady, as opposed to trying to want to see things change. So you can see where that's going, right? Okay, so now there's also been some Fed minutes released recently. Did you see that one? So basically the idea that there's a little bit of dissension. First time since the 90s, I think it was 93, that we had public dissension from the Fed minutes, where some wanted one set of policies, the other, and others did not. Usually, even though there may be differing views, what is publicly put forward is uniform perspective. So in any case, we do see currently there were two dissents that wanted interest rates to be lowered. I think there's conversation. On the one hand, some people think that inflation is a concern, so they're on the other end of the spectrum. And then you have a lot of people in the middle who are saying, let's wait and see. We've got tariffs on the one hand, we've got some various data that suggests that it could be modestly impacting inflation, but will it be long term? Will it be temporary? And then there's also some weakening employment data. So multiple views on this, how it will be played out. But I just think it's interesting that it seems like the approach the president and his team are taking is, well, let's try to replace some of these people.
Yeah, it seems pretty clear that that's the goal.
Agenda. Well, there's also been a lot of speculation when it comes to the Fed as to who may be the next Fed chair. I think there's a lot of, I guess they're economists, vying for the job, essentially.
Yeah. And I think we'll start seeing more dissenting views if interest rates remain unchanged. A lot of interplay for that potential role when it becomes available next year.
So in May of 26 is when Jerome Powell's role is set to expire as chair. Now, whether or not he stays on as a Fed governor or not is an unknown question. He could. I guess it's more common for once a Fed chair finishes their term to kind of move on. But I don't know that it's necessarily mandatory.
No, I think he would be able to be there until 2029 or something like that.
So he could stay on.
Yeah. Seems
what a thankless deal for him if he does. But yeah. So in any case, who might be the next Fed chair? We pulled out some stuff to say, oh, who are they looking at? And there's supposedly about 11 candidates right now that are most prominent. Some names you might recognize. Some of these are former Fed governors and things like that, and some of you might not know, but people may have heard of James Bullard. He's been a frequent CNBC person who's a former Fed governor, I think, St. Louis Fed, and he's pretty plain spoken. I think he's interesting to hear. Larry Lindsey has been a Fed governor, and I think he's been in government as well. Kevin Hassett is a name people will recognize, former director of National Economic Council, and the current Treasury Secretary Scott Bessent is one of the names that is being kicked around as well. So, as well as some other highly regarded, Wall Street types that are in the names as well. So, I mean, who the heck knows, right? At this point, it's like to maybe make a guess about next May. Is way too soon. On the other hand, will the president be more successful at placing pressure on trying to pull Powell from the role? I don't know.
Yeah, I think that
it seems like that has been dissipating, and he's kind of taking a different tact.
I agree.
We'll see.
Yeah, I mean, it is important to note that almost all, at least most of the candidates you mentioned, are leaning towards lowering interest rates, and I feel like that would be a prerequisite to them getting, that seat.
Yeah. Oh, absolutely. Yeah. Absolutely. They're going to be in that mold, right, of trying to be furthering the president's agenda.
Yes.
Right. That's kind of a given. What else did we plan to talk about on the Fed topic?
Well, I think it's important to look at the historical context and see like what has happened when the Fed lost independence or lost some semblance of independence.
Yes.
there has not been a lot of evidence that that is the best course of action.
Policy. Yeah.
And you look at what the scenario I described with Nixon, and while there wasn't an immediate impact, it was, lowering of interest rates in the face of increasing inflation to help with the election odds, which he ended up winning. Worked out for him in that sense, but then the country suffered tremendously as a result down the road.
You can make the whole stagflation thing is beyond the role of the Fed, obviously, and you made that point earlier, but it's worth reiterating that, what was going on in the economy at that time, there's a lot of varying forces that were driving that in the process of, fuel shortages and just the economy was in a very different economy then than it is now.
I definitely don't want to make it like it was just that one event driver. Or that one driver. There are definitely multiple factors, but there's always going to be multiple factors, and it's the factors.
This is an important one.
Factors that are combining to create a certain economic forecast is that's what's going to make or break what happens. I think one of the articles I was reading in Barron's was also talking about the equivalent of the Fed chair in Greece in the last decade, and the I don't know if it's the president or prime minister of Greece, but whoever was making those Fed decisions kept changing out the Fed chair if they wanted to increase interest rates to combat inflation,
to make sure they were getting their policy addressed.
Exactly, and that did not shape up well for Greece.
And you can look to a lot of other locations where you've seen similar kind of stories where when the policy of the central bank is politicized or politically driven, it often does not help the economy. It often is undermines the credibility of that central bank and makes the predictability of policy and the expectations of industry to be more suspect or circumspect of what's going to happen. And it ultimately it tends to undermine economic conditions.
When there is alignment between the leading branch of government and the Fed to that extent, it does make the Fed lose credibility, because then it's not really a data-driven approach. It's not a neutral, outside perspective. It's whatever the president says goes. I look back at examples where Trump was pointing out Powell and saying he should resign or he's going to kick him out. The next day, the market had a negative reaction pretty consistently. So every time that's come up, he had to take his foot off the gas against Powell to some degree.
I think that's a fair point. None of us knows how this will play out. We thought this was kind of interesting just because there's so many variables that have been in the news of late. Thought we'd take a minute to kick it around and point out some of these issues. It's one of many things that you as an investor need to be mindful of when you think about your portfolio. There's so many things to be looking at. What's happening in the world around us is one of those. What's happening in the economy and which sectors and economic data. This speculation on what's happening with the Fed Reserve is in some respects more of the drama than it is the policy that, but there are some policy implications. And ultimately, what I want to walk away as we wind down the show is say, there's a lot for you to be paying attention to as an individual investor. And when it's possible, you may benefit from having some help in the process. And looking at not only some of these shiny objects that are out there, but also some of the mundane data points that can be relevant to how you think about what's happening in the economy and ultimately how you might want to be positioning your portfolio. That is how a financial advisor might be a resource to you to help in a way that's outside of the kind of things you might be looking at regularly. In any case, if we can be a resource in that process, don't hesitate to reach out to us. We are inclined to start with a financial plan and then move to how does that impact your portfolio, and then review how that portfolio is structured, see if we've got the right structure for you. If we can be a resource to you with a second opinion, or if you'd like a complimentary consultation, just reach out. Thanks for being with us. Until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.